Last week, Federal Treasurer Jim Chalmers delivered his budget, and today Dr. Andrew Wilson and I discuss the implications of that for our housing market. There are lots of initiatives suggested for the housing market, including some interesting speculation that inflation could drop to within the Reserve Bank's range by the end of this year. There are a number of other factors that were in the news this week, including the unemployment figures and wages figures that will give us an indication of what's likely to happen to interest rates. And you'll hear how Dr. Andrew Wilson has changed his view slightly on what's ahead for interest rates. If you want to keep up to date with what's happening in our housing markets, subscribe to this YouTube channel and click the little bell icon so we can keep you updated each time a new show comes out. Last week, Treasurer Jim Chalmers handed down the 2024-25 Australian federal budget with updates to some of the key economic forecasts too, from personal and business tax to housing, banking, superannuation, infrastructure, health, defence, climate change and more. The federal budget's got implications at every corner of the Australian economy. But the federal government faced the immediate challenge of supporting Australians dealing with the cost of living increases, yet still remaining mindful of not adding to inflationary pressures. Unsurprisingly, there was a lot of talk about the housing crisis, and many of the housing initiatives were framed in the light of the government's already declared goal of building 1.2 million homes over the next 5 years, a promise that housing bodies and we here on this show, Property Insiders, really acknowledge is unlikely to be met. And it called me cynical, but to me this was a budget drafted for an election year. So in today's Property Insider chat, I'd like to get the thoughts of leading housing economist Dr. Andrew Wilson, Chief Economist of My Housing Market. We'll have a talk about the budget, the implications on property, and a few other things that have happened in the market this week. Hi, Andrew.
Yes, good day, Michael. Excuse me if my voice is a little croaky, but I've come down with a little bit of a cold, so we'll work our way through the croakiness. And no, I'm not an alien, though some people have suggested that might be the case. So yes, it was a very interesting budget, probably a clever budget, and maybe a big tick, particularly in the short term, for the government in terms of perhaps addressing inflation and therefore interest rates. But we'll have a look at that in some depth going forward. And of course, as you mentioned, there was not really any significant change to the supply side issues that we do have in terms of home building and the problems in the rental market, which of course we are constantly referring to, haven't really been addressed other than those at the margin.
Andrew, according to Treasury, headline inflation could return to the RBA's target band by the end of this year, slightly earlier than expected in the Treasury's mid-year economic outlook, but actually a year earlier than the Reserve Bank was forecasting. This, together with the unemployment rate rising just a little bit over the last week, that could be good for interest rates, Andrew.
Yes, I think the energy for the outlook for interest rates has changed. We've had certainly a raft of information over the past week or two that's certainly a lot more positive in terms of the outlook for interest rates. I do think the outlook is for steady as she goes. But certainly the prospect of higher interest rates has certainly faded with this latest data, which is good news. And it'll be interesting to see how the Reserve Bank react to the budget initiatives, as you mentioned. And the budget has announced that it's going to give a $300 annual handout, or a handout for the 24-25 year for household power bills. It is, as you said, according to Treasury, because of the impact that electricity has on the CPI. It is modelled to reduce inflation by 0.5%, down to 2.75% over the 24-25 year. And of course, that is now within the range of the Reserve Bank. The Reserve Bank's range is, of course, 2 to 3%. So it would certainly give some thought for the Reserve Bank to maybe consider cutting interest rates, even though our rates are certainly our official rates are certainly lower than the US and the Eurozone, but nonetheless, it's a positive sign, and we're all going to welcome lower inflation. And if we did get a lower interest rate, that would certainly be welcomed by many mortgage holders. And as you said, Michael, there's even a chance that the inflation rate would fall this year to 2.75%. That's the modelling of Treasury for the full financial year, and a possibility that it would fall to 2.75%. So even though it's, we can be a little bit cynical about this, because guess what, Michael? There's an election coming up next year. So wouldn't that be
Funny about
lovely?
that, yes.
Wouldn't that be lovely for the government to go into an election with an interest rate cut? Gee whiz, that would be good news for them. But the big picture is, of course, this is a one-off subsidy for electricity. It is only for the financial year. So as we saw with the fuel price support that we had during COVID, when the subsidies finish, it does have a significant impact, because you no longer have that support for that particular factor. And of course, that means you also have to pay the extras that has happened over that period of time as well. So it can have a hit, but the government's looking at, can we be cynical? Should we be cynical? Yes, I think we should. But certainly good news for those struggling with high electricity costs, which are, contributing to inflation, and are part of that story behind why our interest rates were, really starting to think about being higher rather than lower. But the news is better now over the past week or two in terms of the outlook for interest rates, which seem to be doing their job. Now, a couple of other things, Michael, as you mentioned, in the budget, in relation to building, for a start, the government announced that it's got around about $6.2 billion in home building support schemes that are in act at the moment. A lot of those are directed towards infrastructure for state governments to supply land and housing. Of course, the federal government can't really do anything significant in terms of the actual volume of housing that we need, because they don't have responsibility for land planning, which is a state government responsibility. So it's a little bit of tinkering at the edges, but it's obviously a positive and will help. But when we look closely, as you've already suggested, Michael, at the targets, are these aspirational targets? I think they're more of these aspirational targets of the government. They're looking to build $1.2 million homes up to the 2029-30 financial year. That's 6 years. And of course, that averages 200,000 homes a year. And just to put that into perspective, which you've already alluded to, the latest data shows us over the year to March this year, we've approved just a little bit over 150,000 homes. Of course, a number of those will not become out of the ground homes to live in. So we're already 25% behind that target of 200,000 a year.
The other thing that's often forgotten, Andrew, is that to deliver some of those homes, we have to actually demolish other homes, not in the new house and land areas, but in the inner suburbs as well. Mm-hmm. So the net effect's a little bit less than that. Now, we know one of the reasons that we're not building enough is because of finance, and they don't work as well, but financially as well as they should for developers to make money. But another reason is lack of labour. We know that there's a shortage of labour in the construction industry. Much of it's going to infrastructure projects. So one of the initiatives in the budget was to actually train 20,000 new tradies. Interestingly, Andrew, that sounds big, $89 million to train home builders, but that's only going to increase the existing construction workforce by 1.7%. It's not going to really move the needle at all. And I think it's going to probably take, I don't know how long it takes to do your apprenticeship and get through the system. That'll be a few years down the track before that kicks in.
Yeah, that's what I was going to mention, Michael. The timelines are quite lengthy as well. And, it's we always, in the boom and bust environment of the, typical boom and bust environment, it's a bit different now. It's not really a cyclical problem. It's a systemic problem that we do, lose our workforce when there is less demand in terms of building workers. And then it takes some time because we have that lag, as you said, to retrain when we do start to get higher demand in the housing market. So, again, this will take some time to filter its way through. And it really is, maybe just a nice soundbite to some degree in terms of, what we're doing to improve new supply, new housing supply. And I thought it was interesting also what they've done. They've probably, thrown up their hands, and I think they have conceded that there's not much they can do for the rental crisis as it's now being widely described. What they've done is just assisted those that are already on welfare packages by increasing rent assistance by 10%. And just to put that into perspective, Michael, and that actually covers 1 million welfare recipients. But
That's
the
a lot.
typical, well, it is, and it just sort of tells you how many people are being assisted out there in
Yes.
terms of their housing. But to put it in perspective, the average Commonwealth Rent Assistance rental is around $295 a week in rent, and then they get $89 in rent assistance. So they're paying around about $200 a week net for rental on average. And when we look at the private market, the current Sydney median house rental is $800 a week, Michael. So we're looking at, those on welfare packages. And we always support those that are marginalised in housing, and that's a good thing. But you can see just how tough the private market sector is when they've got to be paying 4 times as much for the average rent in Sydney compared to what those on rent assistance get.
So, in general, while all these sound good, I can't see it making any difference to the housing shortage, which means that over the long term, we're still going to have low vacancy rates, rising rents, rising property values. No change in sight at all. These are all long-term focused ideas.
Yeah, and I think the big changes will be the change to our to society, Michael. I think we're going to have to start thinking about how doable the aspiration for home ownership is. We've seen with the latest home loan data that first home buyer numbers lending has fallen. No surprise, high rents, high house prices, and high inflation. Is really making it tough for first home buyers to get into the market. And we'll see vacancy rates bouncing around because, we move from a period where people just can't afford to keep paying those significant increases in rents to secure a rental property. So the decisions will be made, well, do I stay at home longer? Maybe I stay at home permanently. Maybe we share the family home. Or do I share a home with my siblings? Or do I share a home with, my friends? Do I look to have a unit instead of a house? Do I have to share bedrooms with my children? Having my children to share bedrooms in rented accommodation? Or do I move to a regional centre, where I can actually afford to put a house over a roof over my head in terms of providing a household for my family? So I think these are the real significant underlying changes as we move forward into this long-term period of undersupply. And the budget has really done nothing to improve that other than to hopefully get interest rates down. But hey, Michael, if we get interest rates down, won't that mean more demand for housing than those that can afford it? And won't that mean higher prices? And won't that mean more investors? And won't that mean even a tougher market for those trying to get in either to the rental market or as first home buyers into the buying market?
Very much so. There was more news in the last week. It depends whether you call it good news or bad news. We probably need bad news to forget the good news for our interest rates to go down. And that was that the jobless
Yeah.
numbers were higher. Bit of a surprise considering that jobless numbers had been keeping below the 4% mark for quite some time.
Well, a couple of months ago, we did have a 4% rate. We've got to take this data with a grain of salt, Michael, to some degree. That does bounce around. but it is moving in the direction that would make the RBA happier. This is still a full employment economy. The unemployment rate at 4.1%, up from 3.9% the previous month. We still had jobs rising, up
Yes.
38,000 following a fall. So, it's still pretty good. Unemployment was up by 30,000 after a rise of 7,000 the previous month. But the real factor behind that lower or higher unemployment rate was the participation rate increase. So there were more people coming into the workforce. So we had a bigger pool to rate our the level of those that didn't have a job, and that was really a significant factor in that higher unemployment rate. So, but still, this is a full employment economy. But when we look at the trend, Michael, I think it's encouraging that we can certainly see the trend moving up from those sort of mid 3%, which was just crazy low, now heading maybe to around 4%. But look, the next few months will reveal that. But unequivocally, our economy is very, very strong. Our labour market is at historically strong levels and just starting to, maybe feel the pinch of migration coming in, Michael, and starting to add to the pool of workers available for the work that's out there. So, and when we look at the breakdown of the states, we can see that all of the states, with the exception of South Australia, are higher now when compared to where they were a year ago. So again, we're starting to push in the right direction, really. And we like to see everybody have a job who wants a job, and I still think we have that in the labour market. But certainly these numbers are encouraging in terms of getting more balance between supply and demand in labour, and therefore more balance in the capacity of workers to leverage higher wages, which gets spent to higher inflation because they're in short supply, those workers.
Another thing in the news with regard to wages and employment recently, Andrew, was that wages have risen a little bit again over the March quarter.
Yeah, look, this sort of correlates, what we've seen in terms of a slight easing in the unemployment rate. We've seen wages growing by 4.1% annually over the March quarter. So that's the March quarter versus the March quarter last year, which is still very strong, not too far below our record levels that we had during that mining boom in the noughties, the aughties, whatever they're
Yes.
called. And down from 4.2% over the December quarter. Still a good rate. And, when we consider that underlying inflation has been tracking at around about 3.9%, Michael, then over that period, it means that we've got positive wages growth as well after a period of certainly negative real wages growth. So, yeah, again, heading in the right direction. What we would hope that we wouldn't have the surge in wages, which is very inflationary, of course, because it does reflect that employers are having to pay higher wages to secure staff. Those higher wages are being supported by higher prices because we really don't have the productivity that, we notionally should have to offset the need for higher prices to cover those higher wages.
On the other hand, though, strong wage growth is bad news for the rate outlook, the interest rates.
Well, it is, Michael, but at least it's heading in the right direction.
Yes.
And
Yes.
we can look at that similarly with the labour market, how that's supporting, again, the notion that, look, we're heading in the right direction. And it was interesting that, as we know, just talking about the interest rate decision by the Reserve Bank, the Reserve Bank now has, or the governor now has, a press conference following the decision. And when I read through the press conference, there was even more, I guess, confirmation that I think the Reserve Bank would be, they mentioned that, or the governor mentioned that they'd really have to have a significant long-term increase in inflation to consider pushing up interest rates. So it wouldn't be a couple of months; it'd have to be a real breakout in inflation, according to the governor's statement. So it's something that would have to become firmly entrenched, I believe, on the basis of that comment that she made in the press conference. So I'm not saying it wouldn't happen, but certainly they would need a consistent and substantial increase in the inflation rate to consider putting up interest rates.
I just wanted to remind you that this is not specific investment advice because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of the opportunities the current property markets are offering. So why not have an obligation-free chat with my team at Metropole to discuss your goals, your options. We're much more than just another buyer's agent. We help you safely create intergenerational wealth through strategic property and wealth advice. At Metropole, we're big enough to tip the scales in your favour, but still small enough to care. And since we don't sell any properties, our advice is independent and unbiased. Now remember, property investment's a process, not an event. So you can't just go out and buy any property and hope for it to be successful. In fact, now more than ever, the right advice is critical. So if you're looking to invest in property or buy a new home, go to metropole.com.au and have a chat with our multi-award winning team. It's a great feeling having the team at Metropole on your side, levelling the playing field. Well, it seems like everything's pointing in the right direction. It's just taking a little bit longer than many of us would have hoped for inflation to come under control, for interest rates to start falling. Each week, we also talk about the auction markets because we like to see what's happening on the ground with buyers and sellers and what their emotions are like. We're now over the holiday period, so we're getting into the winter selling season. Well, it's not really actually winter yet, is it? It's autumn, but people are getting ready to sell their homes. How did things go over the weekend?
Well, yes, Michael, we've got the holiday season behind us now, and it's really just been another steady result for our capital city auction markets at the weekend. We've got about a month to go till the end of the autumn selling season, or the notional autumn selling season, which of course autumn has only got a couple of weeks to go, but the selling season actually finishes towards the end of June. And markets are still performing quite positively generally. The only, when we say steady as she goes, the only, I guess, outsider to that statement was Canberra, which had been showing a revival over recent weeks, a bit up and down, but it tracked backwards again following its strongest result for some time the previous weekend. But auction numbers down a little bit in Sydney, 683 auctions. Clearance rate held just about identical to the weekend before, 73.8%. But the auction numbers again were higher than a year ago, Michael, but the clearance rates were below. And we've said quite clearly that clearance rates are going to track considerably lower than where they were a year ago, because a year ago we were almost in boom time conditions as buyers charged back into our housing market. So we're not going to have that sort of strength now, because those value outcomes aren't there now as they were a year ago following the quieter market in 2022. So Melbourne also down a little bit on the previous weekend. 921 auctions, similar clearance rate, again, 63.6%. Obviously not as strong as Sydney, and still reasonably positive environment for most sellers in the Melbourne market. But, Melbourne still, isn't reflecting the strength of the other capital city markets, and it's well below where it was a year ago, Michael. But again, listings well ahead of where they were a year ago in Melbourne, Michael. And maybe that's part of the reason for that lower clearance rate, that there are more choices for buyers on that sort of annual comparison basis. Brisbane down a little bit, similar. We're saying the same story here for most of the capital city markets, and its clearance rate was also lower than a year ago. Same story in Adelaide, although its clearance rate was higher than a year ago. Its listings were higher compared to the previous weekend. And as I mentioned, Canberra down a little bit, which was disappointing given the revival in that Canberra market, which seemed to be taking hold over the last few weekends, or certainly over the past few months. And as when we look at the annual growth in auction clearance rates, or change in auction clearance rates, we can see that we've had a good pickup this year, Michael. In Sydney, auction clearance rates are maintaining their position above 70%, but lower than a year ago. Melbourne certainly lower than a year ago, but perhaps a bit more consistent, that Melbourne market, although lower over the past 6 months. Brisbane, that has its own sort of individual flavour in terms of auction outcomes. They tend to anything over 50% is a reasonably positive result. But we look back a year to that Brisbane market, which was being flooded by buyers that had come from interstate. And we had extraordinary record clearance rates a year ago in Brisbane, but now they're settling back to more of a normal pattern, and certainly a positive pattern over 50%. And we expect to see more prices growth in Brisbane. Adelaide holding its own, but still a little lower than a year ago. And as we mentioned with Canberra, the Canberra market has certainly started to look like it was picking up, but just faded a little bit at the weekend, and certainly below where it was a year ago. And it did have that fade out over the second part, or the end part of 2023, Michael. And of course, you can get those auction clearance rates, the snapshot, on my LinkedIn account every Saturday night at 6:30 p.m. That's for the headline results. And of course, Michael publishes the full national report on a Sunday, and which includes the regional breakdowns for Sydney and Melbourne, and the top 10 sales under the hammer for each of the capital city markets.
Well, lots of news this week. I don't think it's going to change the medium-term trajectory of our housing markets. We're going to keep having a shortage of properties, people wanting to get into the market. So we'll be back each week to report on how things are going, but it all looks positive and steaming ahead this year.
Yes, as I said, I think the outlook for interest rates has changed over the last couple of weeks, Michael. And by that, I don't mean we're looking at cuts, but I think
No.
we've got a much more stable outlook for rates to remain on hold. There's a lot of decisions if the Reserve Bank were to think about cutting rates, particularly in an election year, and what it can do to maybe reinvigorate inflation, and I think that they would have to be very mindful of that. Also, what it would do to our currency, given our interest rates are already well below, in fact, 1% below the US interest rates, which may, start to come down also in a few months' time. But as I said, I think that, but I do think for everybody, in a sense, Michael, and I know people want relief from mortgage rates, but mortgage rates are still around about where they were at the peak of the last cycle. But steady is better, because you don't create the disturbances that interest rate changes create. Just look at what happened to the market in that roller coaster since interest rates have increased 2 years ago, and we would probably still have another roller coaster environment created if we cut rates, perhaps a little bit too prematurely. In the old days, Michael, a cut in rates was usually because the economy was struggling and it needed a lift.
Yes.
Our economy is not struggling, Michael, by any means. It's going very strongly. So,
Well, the decrease in
time.
inflation is really from the headline inflation by the government giving us those subsidies,
Yes.
particularly the energy subsidy. Underlying inflation is still chugging along, isn't it?
Yeah, and the other positive news that we have had, Michael, that I haven't mentioned, is the price of oil is falling now. Now, this can be quite volatile, so we're not saying anything, but it was pushing up to $90 US a barrel. And we noticed that, I'm sure everybody noticed that with the Bowser price,
Yes.
$2.40, $2.50 for petrol. Now it's down to $1.70. And that's because the price of oil has now got under $80 US. And as we've constantly discussed here, there's a very strong correlation between the price of oil and the inflation rate. And as long as that oil price keeps going down, it's good news for inflation. And that's the real good news that we've had on the prospects for inflation, is thankfully the price of oil is falling. Let's just hope it continues to fall. It's amazing, Michael. It's still double where it was prior to COVID, So, so let's hope that continues and it doesn't, break through again, which what we saw earlier in the year, which pushed up interest rates, the inflation rate, and when we started talking about higher interest rates. So let's hope that continues its downward trend. But it's been a positive couple of weeks for the outlook for interest rates.
Right. Look forward to catching up with you again next week, Andrew.
Thanks, Michael.